All right, let's talk about the U.S. futures market. Now, I know, it can seem like this super complicated, intimidating world, full of jargon and charts that move at lightning speed. But here's the thing. In 2025, with all the economic twists and turns, it's one of the most important places to look for clues about what's coming next. So in this guide, we're going to demystify the whole thing for you.
So let's just start with this wild question, right? How do you trade the future? I mean, it sounds like something out of a sci-fi movie, but honestly, that's the core idea driving this entire market. Let's dig in and see how it actually works.
Okay, here's what we've got on tap. First, we'll cover the absolute basics, what futures are all about. Then, we'll pinpoint the biggest market movers for 2025. After that, we'll get into the three forces driving everything: inflation, tech, and the Fed. We'll even take a peek inside a trader's playbook, and we'll wrap up with what is, without a doubt, the most crucial piece of the puzzle: mastering risk.
All right, part one, futures, betting on tomorrow. Let's get right down to it. What in the world is a futures contract? And look, it's totally normal to feel a little lost at first. As our source material points out, figuring out where to start isn't easy. There are so many different contracts, so much noise, it can feel like a lot. And that's exactly why we're going to start with a super simple definition.
Okay, so what is a futures contract really? At its heart, it's just an agreement. It's a deal to buy or sell something. Could be oil, could be gold, could be a piece of the stock market at a price you lock in today for a transaction that will happen at a specific date in the future. This pre-order analogy is perfect. You're basically reserving something for later, betting that you've just locked in a fantastic price right now.
Okay, so now that we know what a future is, let's talk about where the action is. These are the 2025 market movers.
You know, for all its complexity, the entire market is really driven by three main categories of contracts. Think of them as the big arenas where traders are placing their bets, and each one tells us a completely different story about our economy.
First up, you've got your equity index futures. These are basically your bets on the stock market as a whole. You've got the big one, the S&P 500 E-mini, which tracks America's largest companies. Then there's the NASDAQ 100, which is your go-to for what's happening in the tech world. And if you want to know how smaller businesses are doing, you look at the Russell 2000. All right, next up, we're moving from the world of abstract stock indexes to the actual physical stuff that makes our world run. And that brings us to commodity futures. With all the talk about inflation and global uncertainty, this is where a ton of the action is. You've got gold, the classic safe haven asset people run to when they get nervous. You've got crude oil, which is a direct bet on the global economy, and a hint at what we'll be paying for gas. And then there are agricultural products like corn and wheat, which are a bet on everything from the weather to global supply chain. And finally, we get to the contracts that are tied to the cost of money itself. And honestly, this might be the most influential category of them all. Yep, we're talking about interest rate futures. This is where traders go to bet on what the Federal Reserve is going to do next. The 10-year Treasury note futures, that's all about long-term expectations for the economy. And then you have SOFR futures, which are super sensitive to short-term policy shifts. If you want to know what the market thinks about the next rate hike or cut, this is exactly where you look.
Okay, so we know what's moving, but the real question is why? And in 2025, it really comes down to these three massive forces: inflation, tech, and the Fed.
So check this out. This is a perfect example of how real-world news just slams into the market. After an inflation report came in hotter than expected, boom, trading volume in S&P 500 futures jumped 12% in just 2 days. It just goes to show you how traders use these tools to react instantly to new information.
And that leads us to this little piece of wisdom, which is so important. Often, knowing market expectations for report data is more important than the data itself. And that's the whole game right there. It's not the actual number that causes the fireworks. It's the surprise. Was the number higher or lower than everyone predicted? That's what drives the big moves. So, if we boil it all down for 2025, these are the key drivers. You've got ongoing inflation concerns, which keeps the commodity markets buzzing. You have these big sectoral shifts. Think tech and clean energy battling it out with traditional industries, driving the equity indexes. And of course, the constant uncertainty around what the Fed will do next is what's fueling all that action in Treasury futures. All right, we've got the what and the why. Now let's pop the hood and look at the how. Let's go inside the trader's playbook. You know, when you really get down to it, a lot of trading strategies fall into one of two main buckets. On one side, you have trend following. These traders are all about momentum. They see a train leaving the station and they want to jump on board for the ride. On the other side, you have reversal trading. These folks are trying to do the exact opposite. They're hunting for the precise moment that train is about to run out of steam and turn around, hoping to get in right at the turning.
And timing. My goodness, timing is everything. The trading day has a real rhythm to it. The morning is usually where the fireworks happen, especially between 8 and 11 a.m. Eastern when the London and New York markets overlap. That's peak volatility. Then you get another huge jolt at 9:30 a.m. when the U.S. stock market opens. The afternoon? Well, that's where we find out if the morning's big story has legs to continue or if the whole thing is going to run out of gas and reverse into the close. Okay, let's talk about the single most important thing in all of trading. This is it, mastering the art of risk. Because you can be the smartest analyst in the world, but if you don't get this part right, nothing else matters.
So if you're even thinking about getting started, there are a few non-negotiable first steps. Number 1, always use a regulated broker. Make sure they're registered with the CFTC or NFA. Seriously. Number 2, you have to understand margin. It's the good faith deposit, the collateral you need to even open a trade. And third, before you risk a single real dollar, get on a platform and just track the market. Build watch lists, see how things move, and get a feel for it first.
But risk is so much deeper than just a number. And this quote really nails it. It says that managing risk isn't just about being able to absorb one bad trade. It's about seeing the whole picture, how news, how volatility, how everything is constantly changing the amount of risk you can and should be taking on.
And this right here might be the ultimate truth of trading. It's not about finding the perfect entry. Anybody can click a buy or sell button. The real skill, the thing that separates the pros from everyone else, is knowing when to exit a trade. That's what defines success. Having a plan and having the discipline to stick to it, whether you're taking a profit or cutting a small loss.
So to bring it all home, yeah, the futures market is a machine for discovering prices. But if you step back, it's so much more than that, isn't it? It's a mirror. It's a real-time scoreboard for our collective anxieties about inflation and our biggest hopes for new technology. When you look at those charts, you're not just seeing numbers, you're seeing a story about where we all think we're going next.